Sometimes you need a reminder what type of research you should doing at least before you enter the stock market or some other type of investment like crypto, buying a house or whatever. A lot of people do a lot of research when they are buying, for example, a house, but when they enter the stock market and buying a stock, they just buy a stock and hope for the best, and that's not good enough. It's real money we are talking about here, and if you don't do the correct type of research, you will find yourself having problems getting the results you want, and also you won't be at peace with your investments. So if you want to be at peace with your investment, you need to follow some simple rules, and I will guide you here through the basic steps that I think are necessary to at least go through before you do an investment. Obviously, you can dive deeper than the things I will go through here, but I think these are the basics that everyone should do before they, for example, buy a stock in a specific company. So here we go. Okay, so when you start investing, you need investment goals. You need to set your goals clear on your investment horizon. Is it 1 year? Is it 3 years? 5 years? 20 years? 50 years? Are you saving for yourself, for your spouse, for your children, for your mom, dad? Maybe you need to buy a house soon and can't afford to lose the money you are saving. This means you have to regulate the risk of your savings. Can you afford to lose money on the things you are saving? This will affect whether or not you want to invest in stocks, maybe in bonds, in crypto, in gold, etc. This is why it's so important for you to set clear goals where you are heading, because where you're heading will affect the type of decisions you should make in the stock market. And also, if you don't have any goals, it's hard to stay clear and not be emotional in the stock market, because the one thing you don't want is to be emotional and feel the pain of the company you invest in and the stock price going down 10-15%, and you feel, oh, what am I going to do now? Oh, I sell. If you sell when your stock is 15% down in a week, why did you invest in the first place? Obviously, it should have been a long-term play here, but maybe you're just a trader and that's it. But most of you who follow this channel, I think, are not traders. You want to be long term in the stock market. And if you are going to be long term investors, you need to set clear goals to stay emotional stable. So you need to know your own risk tolerance, what type of person you are. And also, you better not invest money you can't lose. For example, borrow money from family and invest it in the stock market and lose it, you will feel very bad. Also, be extra careful if you are investing in individual stocks, specific companies. The higher the risk, the more you need to know about that company, the specific situation, and also you should not invest all of your money in one company. Obviously, you should diverse your risks. More to that later in this presentation, but the most important thing here is your investment goals, but also not just when you're taking out your money, also the amount of money you want to invest and the amount of money you want to earn. Because if you want, for example, to earn a lot of money, you need a long-term perspective to make that money you invest compound. And the longer horizon, the easier it is to make a lot of money. And it's hard to make a lot of money in the stock market or any type of investments like crypto or housing, etc., in short term. So this is very important to be clear about. Set your goals and stay with them. Um, when you invest, you need to understand the company. What is the business model that the company you invest in has, and what type of industry are the company making their business? So basic knowledge like how are the company making money, their products, the product line, how much money are they making from different type of products. For example, Microsoft. Okay, they have their gaming segment, they have the Office 365, they have the cloud, Azure, the intelligent cloud, etc. A lot of different revenue streams. So how are the growth rates in the different segments of the business? do they have a new segment that are growing very fast? How will that long term affect the company? So the basics like this is good to have. Also, a focus on the services and products, more specific, and you should be able to explain this quite easily about the companies you invest in. Or if you can't, maybe should not invest, because it will be hard to have a long term um, perspective and keep hold of your shares when the company uh, will uh, lose steam in the stock market, for example. Maybe it will be down 20% if you are not really well versed in the company. If you not do not understand the business models, it's very easily to sell on the lows and buy on the highs, being emotional, and that's not what we want. We want to drive profits for the investors long term, I would say. And to do that, you need the basic knowledge to stay calm. Also, what type of industry is the company active in that you're investing in? And how is that industry growing at the moment? Is it growing? Is it shrinking? Because maybe you have the best management in the company. They are doing everything right, but they are in a market segment that are shrinking very fast, and that will affect profits. It will affect revenue, etc. So watch out for that. And maybe you need to take perspective. How has the company being able to be flexible in terms of change in the market and in the industries that they are active in, for example? So if you is the company if you feel like the segment the company is active in is shrinking, will this company being able to stay on top and evolve going forward? Also, the moat of the company, and the moat, to make that simple, is basically what competitive advantage do this company have compared to the rivals? How is the company gonna address the market going forward? How are they gonna take market share from competitors, etc.? What is driving customer specific to this company? What is the moat? So, for example, Spotify, the moat there was free music to good quality, easy access. You don't have to pay for every song, etc. And they just started to grow, 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 grow. And if you find a company that has a great moat and you find it early, you can make a lot of money, obviously. Also, you need to understand the risk of the industries and the company's business model. For example, maybe they have a lot of business just with one customer, and if that customer decides to change, the company might lose a lot of money and the share price will crash. For example, a company named Cirrus Logic, they made like sound chips, I think, to the iPhones, and their main customer was Apple, obviously. And if Apple decided to not have Cirrus Logic as a customer anymore, or do their own chips, obviously they would lose a lot of money. So despite the stock at one particular point being valued very fairly and great growing profits for Cirrus Logic, etc., you need to consider that type of risk before you invest. Also, the specific trends for the sector as a whole going forward. So this is some type of basic knowledge that you probably is a good idea if you look at before you invest. Um, yeah, when you invest, you should have a basic understanding of the three big financial statements: the income statement, the balance sheet, and the cash flow. And I'm not saying that you need to go to high school. I do not think we should make investing too complicated. But if you do hear the word income statement, you should understand what it is. That this is where you derive the revenues, the costs, the profits from the company. It's often the income statement that they are talking about during the earnings calls. It's a very important statements that shows you a lot of information how it's going at the moment for the company. Obviously, the balance sheet, that's the specific debt of the company at a specific moment in time. So you have all the assets, all the liabilities, and also the equity, meaning how much of the assets that the shareholders own, for example. You often talk about shareholders' equity. And then you have the cash flow statements. Many people that are working in companies are with economics are often saying that cash flow might be the most important and most overseen metric and financial statement from investors. Some people might think it's complicated, but it's to make it easy. It is how much cash on hand do a company has in a specific period in time. So if you have a cash flow for a whole year, the amount of cash your business generates will be seen in the cash flow. And you want cash on hand because sometimes you might have a great income statement, but the revenue you get in the income statements are orders, but you don't get the cash in hand. So what the cash flow means is the cash that had actually arrived at your bank account for the company. And why is that so important? Well, obviously that is important because it is when you can't pay your bill that the company can go bankrupt. So for smaller companies, the cash flow statement is immensely important, but it's also a statement that Wall Street are looking very closely at when they are analyzing companies. As you see a bit lower here, the DCF, the discounted cash flow model. A lot of analysts are using this model when they are investing in companies, trying to project forward how the cash flow of the company will grow, taking account inflation, etc. So this is a very common metric when you invest. I'm not saying that you need to do a DCF on all the investments you have, but you need to understand the playing field you are at when you are an investor. And I think even if you don't work in accounting, you can understand if a company has the possibility to grow their cash flow over time. So if they have a product that's over time are getting cheaper and cheaper to make, and they can still sell it for a lot of money, they are increasing their brand, power of their brand, etc. Obviously, that can lead to a better cash flow for that company. So basically, what we want is what I want when I invest is a predictable revenue growth. I want expanding profit margins for the companies. So increasing profit margins is doing through maybe you have still the same type of labor producing a product, but you are getting traction in the market, so you can sell your product for more money. Then you will obviously have expanding profit margins, and you also want a manageable debt in the company you invest in. If we have predictable growth, revenue growth, but we exceed the expectations, that's even better. Obviously, that can make a stock price really rise. Some basic KPIs is good to have because you want to compare the company with its peers to see how it's doing, and if the company is undervalued compared to their peers. Okay, why is that? And you need to dig deeper into that. And also, oh, it's priced higher. Okay, why is that? Why is it that this company should be pricier than some competitor? And through doing these type of comparisons, sometimes you might switch target when you invest, or you find out something very interesting about the company you invest in that makes you more comfortable. Anyway, it's always good to compare, and some of this is the market cap. So maybe you have a company that are ginormous, but the market cap is actually smaller than a company you invest in, and you might start to consider, okay, this company that has 30 billion in cash flow has a smaller market cap than this company that just has 3 billion in cash flow. What's going on here? And then you can kind of doing your own assessment of the situation. Price through earnings is always good to see how expensive the company is compared to how much it actually earns, the profits. And also the same here is price through sales. So that's just instead of having the price through the profits, this is more focused on revenue. It's a very interesting, and I use the price through sales quite often because, for example, in an industry, if you see a company has price through sales on 10 and another company has it like 2, obviously, and they sell for the same price, then the company that have price through sales that are 5x smaller, if that company starts to get some hype, starts to increase their profits, etc., it has the potential to have a lot of share gains, and this has helped me a lot. So do not oversee these KPIs. And obviously the PEG ratio, That means that, for example, if you have a company that has a PE ratio of 20, it and it has a growth rate of 20%, then the company's PEG ratio is 1, and that's basically something we search for. This is just a simple rule. Obviously, investing is a bit more complicated than that, but it's just something to think about. That you don't want a company that has a PE ratio of 20 and have a growth rate of 3%. So then the PEG ratio would obviously be sky high. So that's just a way to let you get this whole picture before you invest. I just want you to have a picture and an understanding before you invest, so you can be comfortable with your investment and not feel like you are just following the stream of emotions out there. And last words on this slide: compare and analyze consensus with your own analysis. So you watch at Wall Street. What are you feeling? Do you see something that the everyday people do not see in this specific company? Do you have any insight maybe that makes you having an edge regarding investing in this company? Oh, that's very good. Maybe that's a true opportunity for you. But if you have that, maybe it will take a couple of years before other people realize it. So you maybe need to stay in that stock for a long time before the share gains start. For example, also compare growth with competitors and be real. Are the growth rates realistic, taking into account industry trends? So sometimes a company can have a lot of profits and the P ratio looks good, the PEG ratio looks good. I've seen this many times, but suddenly the industry trends just change fast. And basically profits can dwindle very, very fast when a company start to focus more on R&D and revenue growth and taking market share. They can put the profits aside for a while and just focus on that. So that's why you need to look at the numbers as a whole, just not focusing on one or two metrics. And that's my management team and governance. So I think it's important to have a good gut feeling about the CEO of the company. Listen to earnings call, and do you get a feel that the CEO is someone you can trust, that is someone that is building this company at the right direction? Um, and how is the management team? I think sometimes if you go into the company and make some research and you find a management team that is very, very good and that do not have enormous salaries in a smaller company, for example, they can really do something amazing, and it can be a tremendous opportunity. But obviously it's not the easiest metric to look at, but I always think it's good to have a good feeling about the management team. And what you can look at is, does the management team own stock in the company? If they do, for example, they are probably aligned with investors, but you don't want them to maybe own stock options that are so big that it will hurt the growth of the company. For example, you may remember Teladoc Health during the pandemic, a stock that was really flying high, but they had so much options. So when the stock started to gain traction, and the company actually did lose a lot of money on the options. So is the management there for the shareholders, or are they pushing decisions that do actually hurt the shareholders? That has happened many times. So you need to watch out for these things. Also, governance, meaning the board. So sometimes the management might be good, but the board, they are indecisive. They change management too often, change CEO too often, do not have a long-term vision. They want to put money in their own pockets, etc. So you need an independent board that have understanding of the company. Sometimes you need a board that can push the CEO and the management team in a direction and put some pressure on them to perform. Also, the smaller the companies, the bigger the risk are with these type of things. You can have board members that are active in different companies, etc. So it's not easy as an investor to keep hold of these things, and but I think it's a good thing to do. And also, you should listen to, as I said before, on this call, and just get that. What type of feeling do you get when you listen to them? For example, Amazon. Since Jeff Bezos ended his term in Amazon, and I listened to the earnings call, I don't I don't feel it when I listen to it. I don't get any good vibes, any good energy, any excitement. So despite Amazon having an amazing business model, I just can't invest in them based on the feeling I get from the management team. So uh, everyone will not agree with that statement, but that is just what I'm trying to tell you here. It's the same as at your work. Obviously, um, your chief is important for you to do a good job. So the CEO is the most important here to have a great vibe and a great energy in the company going forward. So do not underestimate that. And this is my last slide today. Diversification. And with this, I mean that you need to diverse your investments. It's usually more important not to lose money in the stock market than it is to find one winner. That is why many are investing in index funds, mutual funds, etc., with a basket of companies. Then the things I've talked about here is not as important, because if one company is doing bad, another is doing good, etc. um, Spread your investments. So some own stocks in maybe different industries. As I said before, it can be cyclical. Some industries might be doing worse. Then, you have stocks. Not all of your stocks are going down with that industry, for example. Some have bonds are more safe, gold rates, where you get a lot of dividends from the property sector. And you need to be clear about what rules you follow when you invest, and maybe have some safer companies with dividends like Coca-Cola, and maybe some other high growth companies that are having potential, like Palantir for 3 or 4 years ago. So it's just hard if you just have high risk stocks, and you also none of your 15 stocks actually made a profit. Everyone just got useless. Then you have zero money left, and you can't make a comeback. The money is gone. So that is why it's easier to have a more diversification in your portfolio. Also, fewer companies. If you have fewer companies in your portfolio, that means that you need to analyze them more in depth, because there will be bigger risk, and you will feel that emotional pressure when that stock you have that is 30% of your portfolio are going down. Maybe it's 15% down, 20% down in a month. It will be hard on you. It will take a toll on you if you not have done enough analysis, because sometimes even when a stock is, even when the management team is performing well, the profits are going up, the revenue is going up, they are winning in their segment, the stock price might still go down 20-25% just a couple of months, and it will be hard. And you might say, oh, this is no money to find here. This stock will never answer to real fundamentals. It's just driven by um, algorithms and AI. Stock market is dead for me now, and you will sell out, and then boom, suddenly the stock goes up again. So it's just to stay emotionally stable. You need the diversification. If you have just one stock, um, then you need to really, really dig deep into that stock and be certain about what you do. And also, you better think about the macro perspective. Are we going into an area where the growth rates in the world are slowing down, a growth rate in the specific industry, etc. Also, when you invest, understand how is the tax rules in your specific country. So how is the capital gains on stock working, the transactions cost for investing in foreign countries, etc. All these things is important, so be clear about the rules. Okay. And lastly, I did say it was the last slide, but this is one extra. And I think it's important to understand your own type of psychology when you invest. So for example, this is a Myers-Briggs type indicator about what type of person you are. And some persons are just, it's easier for them to stay focused long term in the stock market and not selling off stocks, etc. So through understanding yourself, you can make better judgment based on the type of person you are. So some persons are extroverts, some are introverts, some are more sensing, some are more on intuition. Some people like to think a lot before they invest, and others goes on feeling, and some are more judging, and some are more perceiving. And through this and combinations of the type of persons you are basically gets you into different type of categories. And if you do this type of test, I think you can do it for free. You can understand what type of person you are, and if you are someone that should be in stock market, and if you are a very, for example, visionary person or campaigner, you should be careful because it will be easier for you to lose money, and it will be harder for you to use the type of tactics I am providing here. So, for example, the mastermind, you have the introversion, the intuition, the thinking, and the judging. So this is a strategic long-term planner, classic investor type, basically like Warren Buffett, for example. While the ENTP is more going more with extraversion and more with intuition. This is someone who loves disruptive tech, startups, high risk, high reward, etc. So what I want to tell you here is understand yourself is so important, and understand your limits. And is stock market something for you? Obviously, if you know your weaknesses, it's same as a leader. Then you can train them, you can correct for them. So I just wanted to bring that to you. Understand yourself. That's important. Anyway, I hope today was something useful, and it made you realize that sometimes it's better to slow down and have patience before you enter an ownership of a company, for example. And anyhow, anyway, have a great day, and thank you for tuning in.